Hey guys, this is Chris Mancola with the Mancola Group over at West USA Realty, and I'm going to be doing our weekly housing market report or update. And let's jump right in. I'm going to share my screen with you here real quick and just kind of run through a couple of things. Right now it's kind of confusing on what's going on if you're listening to, this and that in the media. So I'm going to kind of break it down for you real quick, and we'll take a look at what they're saying. So, right now, basically, the Fed is, saying that they're serious, that the economy is not, uh, the inflation is not being tamed quite yet. And we're probably going to be heading into a recession if we're not already in a recession. Again, some of this sounds redundant, but inflation drives interest rates, and that basically drives affordability. And that's why we talk about these things. That's why we talk about what the Feds are doing, whether you agree with them or not, whether you like what they're doing or not. This is where it is. So we see that the cost of everything still high and going up. And when they came out with the personal consumer expenditures index, the Feds basically assessed that rising costs in the economy still happening. So they're going to keep basically doing those 25 basis points is what they've been talking about every month until we get to where they want to be, or we hit a recession. Now again, if we hit a recession, it's bad. We'll probably see some people out of work, but we'll also see interest rates go down. Okay. In every recession, we see interest rates go down. And what that means is we're going to see, we're going to see interest rates come down. We're going to see more affordability for people. So we definitely may have like a 1% uptick in unemployment. That's certainly possible. But we also may see, if interest rates come down 1% or so, give or take a little bit, we may see, up to, 4.5, 5.5 million people be able to now afford a house again. In the last, week and a half or week or so, we've seen a lot of, volatility with interest rates. Interest rates ticked up a little bit again because of these reports. Okay. But, we are looking at, pending home sales improving. According to Redfin data, pending home sales improved slightly, but an ongoing affordability crisis and lack of homes for sale kept many house hunters on the sidelines. Now, a lot of people, first-time home buyers may not be able to afford these higher interest rates, okay, or may think they want to wait, for the right time to do it. Now, I'm going to share something with you. I've shared this many times, but I'm going to actually have Barry Habib tell you himself here in a very short video, just a couple minutes long. And I'm going to play that for you in a second. But, you've also got low inventory. Low inventory will help to keep, a stable market as far as pricing is concerned, or a normal pricing market, in other words. So we went up. Yes, we went down a little bit, which I'll talk more about in a second, in the past year, but that's due to the interest rates and the supply and demand. Supply and demand is always a driving force in any product that we're talking about. It's the same for housing. So, a lot of people who have the lower interest rates right now that already own a home that may be thinking about moving or buying a second property or whatever, they're like, well, I can wait. There's not a ton of inventory right now anyway. I'll wait till there's a little bit more inventory. I'll wait till rates come down. Then I'll make my move, and so you've got some of that going on. And a lot of the investors, again, have pulled out of the market just because there's a lot of this uncertainty, and maybe they don't kind of understand where things are heading. So, to look at this, we're seeing that things are, plugging along, and we're seeing a slight improvement. The last week we did see a little drop off because of those higher rates. But I'm going to just have Barry Habib again explain what I've explained for the past several months, and kind of get into this with you real quick. So here's just a couple of minutes straight from Barry Habib in this interview or report.
Should you high interest rates keep you from buying your dream home? Time for an expert. Last month, home buyers pounced on purchases when mortgage rates were lower than recent highs of 7%. weakened home prices for the 6th month in a row. Now mortgage rates are back up. According to Bankrate, the national average for a 30-year fixed mortgage is 7.02% this week. The average 15-year fixed rate is 6.34%. There are a lot of numbers here. They do expect that these numbers will go down a little later in the year, but is it best to wait? Should you be just saving your money and dreaming and hoping that your time will come? Well, we asked Barry Habib, CEO of MBS Highway, an industry-leading platform for mortgage loan officers, to share the keys to home buying. Okay, so let's just get right to it. Should we buy right now? Can we buy? Is there a way to get around those high interest rates?
Well, thanks for having me on. And yes, I think that right now actually provides a very interesting opportunity. So we had seen interest rates dip just a little bit in January. And what happened? Activity sparked. And as activity sparked, we had multiple offers and sellers were less likely to give you a bit of a discount on that home. Now, what we have to understand is why did interest rates move up during the month of February? You could trace it to the jobs report that we got that would appear stronger than expected, but it really wasn't. People thought it was a blockbuster jobs report of 517,000, but that actually came from something called a seasonal adjustment. In addition to that, it was something called a population control adjustment. It sounds like it should be in a sci-fi movie, right? So what is a population control adjustment? There was some workers that were undocumented that were picked up from 2022 that logically, to me, should have been reattributed to those months in 2022. Instead, they lumped them in to January of 2023. They weren't really created there. And as a result, the unemployment rate went down to what appears to be a 50-year low when it really wasn't. So the key here is to understand that when we get the March jobs, or when we get the report for February on March 10th, that will more than likely be more indicative of where the market is. Maybe rates begin to come down. And mortgage rates really depend on inflation to drive them.
Okay, Barry, real quick, you are way smarter than me. So I want you to tell me, like, bottom line, if I am trying to get a new home and it's just unfathomable to me to have 6% interest rates or 7% interest rates, is there a way that buyers can save the money that they need to afford the home?
Yeah, well, right now, what you could do is you can utilize a little bit of fear in the market to get the seller to not just drop the price, but instead of dropping the price, which they're more willing to do, use something called a seller contribution. Take that money and utilize it towards something called a 2-1 buy down. You could bring the rate much further or buy down your rate permanently.
Okay.
This will allow you to get a rate probably in the 5% range on a permanent basis or below 5% on what's called a 2-1 buy down. Now that rate will go up, but if you believe like we do that inflation is coming down, that'll give you the opportunity to refinance. You could save tens of thousands of dollars in the price of the home and only spend a small difference in the difference in interest rate. So it's a smart opportunity to take advantage of that today, because if you wait till interest rates come down, and we believe strongly that they will by the middle of this year, then you're going to have very much competition.
Yeah.
Driving prices higher. And I think you'd be happier if you took the lower price today, slightly higher rate, than refinance and get the rate you want.
I love it. I love it. You made that so crystal clear. Thank you so much. 2-1 buy down. Google it right now. Barry Habib. Thank you.
All right, guys. So that's straight from Barry Habib, 3-time crystal ball winner. Again, I'm not an economist. He runs MBS Highway, and he, basically is pretty much never wrong, unless, again, like he says, everything's what's likely, using the data points, using the history, knowing how the economy is supposed to work. There are things that can come out of left field. Again, a lot of what's caused a lot of this inflation is the extra money that was printed during, the COVID relief stuff. That was a big part of it, along with some of the other policies that we're seeing, on energy, which certainly, brought up gas prices. And when you bring up gas prices or energy prices in general and kind of, not let that loose, there's a little bit of an uncertainty for the energy sector, and they're going to charge more. So that's just how that works. And right, wrong, good or bad, whether you like it or not, that's just where we are. But the inflation drives mortgage rates, and that drives affordability, obviously, is the whole point of this. But what he's talking about is what I've been mentioning: 3-2-1 or 2-1 buy downs. You get the lower price right now, you get the lower interest rate this year with those programs, and you can even have the seller pay for it when you buy the home, and you get ahead of the curve before the demand and the pricing starts going up. Once the rates drop, he's talking about next month, we should start seeing some relief. And then the other big date that we're looking at, that I mentioned before, that he's mentioned, is May 10th, and then into June 1st, because those are remember, when the Fed makes these announcements, there's always these dates of their announcements, and then that kind of drives the market. And then, but it's always a lagging effect. They're always announcing what happened last month. We're also looking at what's going on now, and we're looking at what's going on in the hyper local market of the Phoenix area. So let's look at this real quick. Inventory right now, using this number right here in the middle, it gives us today, right now, live active inventory for all home types in the greater Phoenix area. There's only 14,989. Again, to give you context on that, for a regular balance, a real true balance market of, let's say, 3, 4, 5 months supply, we would need to be like around 30,000 homes or more. Okay. Right in that range, on a consistent basis. Obviously what's going under contract comes into that too, but just in general, using round numbers, that would be what the inventory would need to be for a complete balanced market. For an out of control market like we saw in 2008, that inventory would have to be, or was, 58,000 homes for sale back then during the crash. So putting all this in context, this lower inventories actually kind of kept things in more of a balanced sort of range for us, because again, everything is about supply and demand, and again, inflation in regards to mortgage rates. Okay, so you kind of understand those basic data points of supply, demand, what the supply should be. We'll look at the demand here in a second, and what makes those mortgage rates go up and down. Then you kind of have a better grasp on where we are and what's going on and what I'm talking about, and what people are talking about when you hear these things. So okay, so let's stop that screen share, and then I'm just going to share some things with you that kind of give us a better context of what's going on in our local market here. This is for the greater Phoenix area. If you want more information about your local neighborhood, zip code, days on market, average list price, median list price, all that kind of stuff, or sales prices, let me know, because we can look at what's sold, what's under contract, maybe what's expired, maybe what the price bracketing should be strategy for your home, and how that works as far as days on market, which is another indicator of, you want to be at that, you want to sell the home a little bit faster, do you want to wait a little bit longer, do you want to get a little bit more out, you want more foot traffic, all those things kind of come into play. So listings under contract, right now, we're looking at right around 8877, which is actually pretty healthy, but it has leveled off just a hair from where we were about a week and a half ago, only because of the higher interest rates, like we just heard in that newscast, and I mentioned earlier. Now, year over year, we're down right around about 3,500 of where we were last year at this same time, as far as listings that are under contract. Okay, so that gives us an indicator, a really good indicator of what's going on now with what's under contract, as far as the numbers of listings that are actually under contract. Now, the local gurus for our multiple listing service, where all homes are listed for sale and sold, or 99% of them anyway, they have an index. It's called the Cromford Market Index, or the CMI. That CMI basically tells us that below 90 is a buyer's market on their index, over 110 is a seller's market, over 120 is a good stable indicator of a seller's market. Okay, over 120. But dead center balance, or between that 90 and 110 range, is of course 100. So that gives us an indicator of supply and demand and where the market is and how healthy it is. So right now our overall index is 126.7. That has been steadily going up and kind of stabilizing over that 120 mark, well above 110. So we are technically in a seller's market overall, but not a crazy anomaly. I mean, when we were in the crazy market before, again, we were in the high 400s. So that was insane. Demand index is at 81.9, almost 82 there on demand. So demand overall with what's going on definitely is pretty strong considering, you know, and again, part of this is seasonal too, because we're just kind of heading into the busy season anyway, because people want to move when school lets out, right? And get back in, you know, unpacked and ready to go, maybe go on summer vacation before the new activity starts for us in August, right? And our school lets out in May. So that makes sense. All right. So supply index is 64.6. Again, you know, below 90, you know, and below 90 on both of those. When both of those meet, they kind of go into a balanced market, but they're pretty far apart right now. But the overall index is giving us a seller's market. So if we look at the cities individually across the board in the greater Phoenix area, okay, this is again the greater Phoenix area, all the cities. Chandler is the #1 seller's market this week, up 21%. That's at 179 on the index. Okay. And, you know, everything across the board is in a seller's market. I will tell you that Paradise Valley, Cave Creek, and Scottsdale had trended down a little bit this week, but they're still in a seller's range on the index. Surprise is, let's see, Surprise and Goodyear are both in balance markets. Okay. And the bottom of the seller market would be in the seller range would be Peoria. And then Queen Creek, Maricopa, and Buckeye, those are all buyer's market right now, but they're all trending in the direction of a seller's market. Okay. So that's where we are across the board there. So if I didn't mention your city specifically, it was in a seller's market. All right. Under contract, just for the sake of time, right? But I'm more than happy to go over these figures and with you, you know, individually for your area, your zip code, you know, again, follow, subscribe to this, like this, share this, and be sure to reach out. I'd love to be able to answer any of your questions about your area, your home, and all that. So under contract right now, the weekly average list price, this is list price. We are at, you know, we were at on January 11th, we were actually at 302 on that day, 302.97. The weekly average that week was 303.18. And I mention that only because this week on the 25th, taking this from the 25th, our daily, or this past week, the daily average was 301.83. That was the daily average. And the weekly average was 390. Okay. So that gives you an idea of where we are. It's kind of stabilized right around that 300 mark, a slight tick down, very slight. And again, that's interest rates, right? Interest rates squeezing people with the difference in what we showed you earlier on that video and where rates are. And again, when you see those rates like that, those are average rates, right? So if you have a better credit score, you know, dealing from one lender to the next, the pricing and all that, you know, may be obviously better. And then if you do the 3-2-1 or the 2-1 buy down, or you work with a broker like we have as a preferred lender, you're just going to get better pricing. Okay. So, all right. Average list price per square foot. We saw this going up gradually since January. So that's a good indicator. Let's see, list price per square foot. We are at 355. Now that's kind of leveled a little, just a hair, but it has been steadily going up the whole year. Okay. And then we are at 400, and for the median price, this is median, not average, but median price, okay, for residential resale is, let's see, for 2023, it's 410 right now. Okay, 410. And then last year we were at 425. Okay, so obviously it's gone down. Again, it's gone down. Let's see, I wrote it down here, about 14 to 15%, depending on which day we're looking at, because it fluctuates a little bit. But it's down about 14, 15% overall. But again, we were in a crazy anomaly market. But when you look at where we were up, because we were up to 475, okay, that was the peak. Okay, right around, let's see, that would have been right around late June. We were at our peak at 475 median price. Okay, that was our median price. Usually median is going to be typically a little bit lower than the average. So our expired listings, we get this question too, and this is important, and this is something that should be shared with you, when you're looking at pricing your home. It should just, at least be mentioned. But expired listings year to date, we did see a little bit of an increase from the beginning of the year. We were up to, let's see, and again, this is a little bit of a lagging thing for into last month. So it's a little bit lagging. I don't have like up-to-date numbers. We won't again for, well, probably we should be having that in the next couple of days. But anyway, 674 is where we were in expired listings. And I can't, let's see, greater. Yeah. For the canceled listings we had, there were actually down. Canceled listings were actually down over the last week by, they were down quite a bit. They just kind of dropped right off. And a lot of that has to be with going into the new year, people wanting to list their homes coming out of the holidays and all that, right? So that makes sense. So I would say, overall, again, we're technically we're in a seller's market. We're in a healthy seller's market where it's not insane, right? Things are, in other words, moving along briskly. Every area is going to be a little bit different, but overall, as I said, most cities are in a seller's market or trend. And we know that when interest rates drop, as Barry mentioned earlier, right around March, we should see some relief on that. Okay, we see some relief with some of those lagging factors you talked about and how they lumped some of that unemployment and employment information into January and stuff. So there's also an adjustment for insurance in there in January. So again, once we get into March, we'll see that March 10th number. We should see a little bit of relief, and then April is going to be kind of a little, okay, most likely. And then once we get into that May 10th and June 1st and early June, mid-June, we're going to see some big drop-offs or decent drop-offs in inflation, which means we're going to see some good time information for interest rates. Okay. So inflation goes up, interest rates go up, inflation comes down, interest rates come down. And recessions again, and except for 2008, because that recession was caused by too much inventory, poor lending practices, which led to a housing recession and a recession overall. Every other recession we've ever had, what happens? Interest rates eventually go down. Okay, so that's the upside of a recession. Okay, and typically housing does well, except for 2008, because that was specifically for that. We see that housing does well, equity does well. Again, not crazy anomaly years like we had last year. We just can't, again, you got to act like, normal, right? We're dealing with normal. But we'll see, a steady kind of regular balanced market. And then going, into next year, we should see some real stability as far as rates coming down even more. Okay. So guys, if you have any questions at all, please reach out. Please subscribe, share this, like this, follow these social media pages for us. We would love to be able to hear from you, ask your questions like you did with the expireds and cancels. That was great to get that out there. And again, it's something that should be shared with you, specifically for your sale in your home. Reach out to us anytime, 480-788-8569, or check us out at Mincola Homes, mincolagroup.com. Or mincolahomes.com, and home@mincolagroup.com is the email where you can get us also. We'll see you guys next time. Thanks.